Alright everyone, welcome back to another TA episode on the Bitcoin on-chain metrics. If you're new to the channel, warm welcome. So in today's video, TikTok next block, we're going to be talking about a plethora of on-chain metrics from the hash rate distribution, the network difficulty, fees per transaction, confirmed fees, confirmed payments, and unique addresses used. So let's jump right into today's video. To start off with, you might be thinking, TikTok next block, what does that mean? Let me explain. Well, if we look at the Bitcoin price has been massively cascading to the downside for the past couple of months to year. Now, while the price has been moving to the downside, the on-chain metrics have been diverging and the network is becoming more valuable. Subsequently, the price goes down, but the Bitcoin network does not care. The Bitcoin network constantly has a value increase, and subsequently, TikTok next block, the price does not matter. The Bitcoin network is becoming stronger. So if we look at the hash rate, we're having a massive bullish divergence from the Bitcoin price, because price goes down, the hash rate goes up. Why do we care about the Bitcoin hash rate? Well, the hash rate is a much better indicator at judging the value of the Bitcoin network. Now, the Bitcoin price is simply the function of its supply and demand. However, when we look at the total hash rate, this is a perfect indicator to judge the value of the network. Why is this? Because if the hash rate was at 0, or if the hash rate was really low, this would mean that Bitcoin would be highly centralized, because there are not many people mining Bitcoin. Subsequently, there are less miners validating transactions, and the hash rate would be lower. When the hash rate increases, it means that the network becomes more decentralized. There are more people using the network. There are more people mining the network, and thus the value of the network increases. So the price, once again, is going down. The value of the network is constantly increasing. And I made a video about the hash rate the other day, and it did come up and make a new all-time high, which is absolutely beautiful. You can see in local terms, Bitcoin's coming down, making local lows. In all-time terms, the hash rate is coming up and making all-time highs. Now, if we plot this on the raw values, specifically looking at the past 30 days, you can see up here at 266, this was the total all-time high for the hash rate. And since then, we have started to move down a bit, still making higher lows. I would like to emphasize it really doesn't matter if Bitcoin's making new all-time highs on the total hash rate every day. If we look at the 7-day moving average or higher moving averages, you can see that we are still pushing up into all-time highs in terms of the moving average. And I think it's important to plot this on a moving average scale, because when we plot raw values, you can very much see that it's up, down, up, down, up, down, up, down, but it's still a steady increase to the upside. So when we look at this in terms of our moving averages, 30-day is coming up to new all-time highs. 7-day is currently pushing into new all-time highs, which is absolutely great. Once again, the price is simply a function of the supply and the demand of Bitcoin at that moment in time. The hash rate is a much better indicator of the Bitcoin network's value. Let's move on to the next indicator, and this is the hash rate distribution, meaning the amount of miners mining and validating transactions. Now, the hash rate distribution, what I want to say about this is becoming more and more decentralized over time, and we'll jump into the hash rate distribution over time in just one moment. But as you can see here, the amount of validators, ant pool being the highest, it's not a large amount of the network. Now, you would need more than 51% to stage an attack on the Bitcoin network, and it's a lot harder than you think to stage a 51% attack, because not only do you need 51% of the network, you need to have a 51% attack and mine 2 Bitcoin blocks back to back. You can have a 51% attack, but in order to attack the network, you would need to submit an incorrect version, or you would submit a fake version of the Bitcoin blockchain within one block, and you would hope that that block that you mined is the one that goes through, and then subsequently you would need to edit another block, the next one over, and you would be hoping that you can mine 2 blocks back to back in order to create what is known as a double spend, which is the problem that Bitcoin tries to solve. If you read the white paper, you'll know all about that. I won't jump into it any further. One quick thing I would like to say, if you haven't read the Bitcoin white paper already and you are invested in the network, I love you, but what are you doing? I have made a audiobook on my channel where you can simply click on my playlist, go over to the Bitcoin audiobook, click it, sit back, grab a beer for 25 minutes and listen to me read through the entirety of the Bitcoin white paper. So I definitely recommend that if you haven't already read it, that you definitely read it or listen to an audiobook. It doesn't have to be mine, anyone's. But that being said, the hash rate is very, very decentralized, and it does not look like there's any chance of a 51% attack coming into fruition. But with that being said, not only would you need 51% of the mining power, not only would you have to mine 2 blocks back to back and submit your own edited version of the Bitcoin ledger within both of those transactions, it's not even as easy as that. You would also need to compete with the longest chain, which in the Bitcoin white paper is referred to as honest chains. Now, within the honest chains, you would have to have been mining Bitcoin blocks for years and years and years to compete with currently honest nodes. Now, with that being said, let's move on from the hash rate distribution. Let's talk about the hash rate distribution over time. So what you'll notice with this one as well is that the hash rate distribution, no matter what you're in, whether it's btc.com, others, Antpool, etc., these are all going down very, very fast over time. Now, Poolin, this is one of the ones that has managed to stay relatively flat, which is somewhat impressive, but the rest of them you can see are all diminishing over time, and predominantly they're going down, meaning that other people are competing for the hash rate. Other people are mining Bitcoin. There are new companies coming out to mine Bitcoin. Individuals are setting up their own Bitcoin nodes and validating, their own transactions. So it's going to become harder and harder and harder over time to stage a 51% attack and, take over the network. Now, with that being said as well, you may notice there is a large chunk of the network in the unknown pool. This is not one validator, this is not one subset of validators, this is a multitude of validators, it says over here. It simply means that they are unable to determine the origin. So for example, if I was to start my own Bitcoin node, no one really knows who I am. It's not like I'm F2 pool or a large entity or anything like that. So I would come underneath the unknown category. So hypothetically, the larger this unknown category gets, it means the higher proportion of smaller miners are taking up a larger percent of the network, which is absolutely great. This is what we want. We want the network to be more decentralized, and subsequently, looking at the hash rate distribution and looking at the hash rate distribution over time, you'll notice a trend that the network is becoming more and more decentralized, which is great. Another bullish metric for the on-chain metrics over on Bitcoin is the network difficulty. Now, subsequently, this ties into the hash rate. Now, when the hash rate is increasing, there are more miners, or miners are using more sophisticated equipment to compete to mine a specific subset of blocks, or they're mining block over block over block, and that's what they're competing for. When there are more miners, which is emphasized in the total hash rate, the network difficulty increases. Now, Bitcoin has a mechanism called the network difficulty adjustment. Now, every now and then, it adjusts the difficulty of Bitcoin mining. For example, if there are a massive drop in the Bitcoin miners, like here, this was the China Exodus, what happens is the Bitcoin network makes it less difficult to mine blocks. So subsequently, you don't have to spend as much money or money on mining equipment to mine the same one Bitcoin block. And when the network difficulty increases, it simply means it costs more money to mine one block. And subsequently, when it costs more money to mine a block, and when it costs more money to subsequently earn that reward from that Bitcoin block, then the price will normally follow, because miners are not willing to sell their Bitcoin that they've got from validating transactions for a lower price when they're paying a larger amount of money to mine that same Bitcoin. So, moving on to the next metric, this is the fees per transaction. Now, with the fees per transaction, you'll notice that this predominantly follows the Bitcoin price, and there's a good reason for that. The higher the Bitcoin network is congested, then the more it will cost to send a fee. So for example, you can see at the top of the bull run, everyone was sending their crypto to Coinbase. This is why Coinbase crashed. Everyone was sending their crypto to Binance. Everyone was sending their crypto out of their ledgers, and subsequently there was a lot more fees going on in the network. Because of that, the cost per transaction increases. And what you'll notice is within every market cycle, so, you know, the lows from down after the 2015, or the lows before the 2015 bear market, are all the way down here at 10 cent. Subsequently, after 2015, I mean, we can find lower lows down here. I mean, we can find one down here approximately at 5 cent, and then you come over to after 2015, the lowest we can find it is at 6 cents. So we've got a higher low over on the fees per transaction. Come over to December 2018, you'll be hard pressed to find anything below 15 to 17 cent per transaction. Come over into 2020, what you'll notice is 30 cents seems to be the bottom, and currently looking at where we're sitting at this moment in time, we are capitulating down back to the lows, and in April 2022, the minimum cost per transaction was $1. So when you notice the fees per transaction starting to move up, this should be a bullish implication. This should have bullish implications rather over on the Bitcoin price. So keep an eye on this. While this is moving to the downside, it probably means less people are using the network, less people are buying, etc. And also, the fees per transaction perfectly correlates with the active addresses. Now, I've made a video before about the active addresses. If you're a seasoned veteran to my channel, you'll probably already know that this looks like the Bitcoin active addresses, because when the active addresses spike, subsequently it normally means people are sending their crypto over to exchanges and they want to liquidate. If I quickly show you the active addresses, actually, let's see. The unique Bitcoin active addresses that are either a sender or a receiver. And what you'll notice is this price chart here literally correlates to, you know, the 2017 top. This correlates to the April 2021 top, and subsequently as the price spikes on, or rather as the active addresses spike, this is normally when the Bitcoin price tops out. And this is exactly what we see with the fees per transaction. Let's move on. So confirmed transactions per day and confirmed payments per day. So for example, with the confirmed payments, this would be a payment to, you know, someone else's Bitcoin address, whereas the confirmed transactions could simply mean that you're transferring over to a different wallet that is a subset of your main Bitcoin address, or you could just be sending it to, you know, one of your other addresses. So for example, Coinbase to Ledger, Ledger to Coinbase, and it will recognize what that is. Now, once again, this is another metric to quantify the value of the network. Why is this? Well, the more people that are sending transactions, the more people that are sending payments on the Bitcoin network, you can imagine it's got more adoption. If there was only 10 people that held Bitcoin and they used it as a payment to each other, the network would be worthless. However, when the network has a high volume of users, when there's tons of users using the Bitcoin network and there's more people making transactions, when there's more people in El Salvador using the Bitcoin network to, you know, pay for groceries, pay for rent, all of that good stuff using the Lightning Network, then the payments go up, the transactions go up, the use case of Bitcoin goes up, the value of the network goes up, and obviously more people are using the network, which boosts adoption, which in turn increases the value of the network. That's all I want to say for this chart. We are having a massive run up over time on the confirmed transactions and the payments per day. Now, last of all, the unique addresses used. Now, within the unique addresses, this is another metric to value the network. Now, just like the confirmed payments per day and confirmed transactions per day, you can imagine the more unique addresses used. So for example, if you have one ledger and you've got a plethora of addresses in there which are, you know, a subset of, you know, one major address. So for example, if you got a ledger and you have a 24-word seed phrase, and you will have one main wallet, and you will be able to have a ton of subsets of ununique addresses beneath that. But the unique active addresses, they're much more of a higher metric to quantify the value of the network. So for example, if I have my own wallet, you have your own wallet, your nan has your own wallet, you know, your pet dog has its own wallet, the value of the network goes up because there's more unique people, more unique entities, more individuals using the network. So as you can imagine, as the unique addresses go up, the more people are using the network, which is very, very bullish. And what you'll notice is even though the price is going down, in the past year, in the past 3 years, the unique active addresses are going up and up and up, meaning that there are more people adopting Bitcoin even though the price is going down. So I hope you found some value in today's episode, TikTok Next Block, where we looked at the on-chain metrics, we looked at the hash rate, we talked about how it's becoming harder to subsequently mine a block, how it's becoming more costly to validate transactions, and subsequently when the hash rate goes up, the price normally follows. We talked about the hash rate distribution. We talked about how the hash rate distribution over time is going down, meaning the network is becoming more decentralized. We talked about the network difficulty increasing. And as such, it costs more to mine the same Bitcoin, and the price should soon follow unless miners are selling for a loss. We talked about the fees per transaction. This is going to be a great metric. Once you start seeing the fees per transaction move up, it should mean that more people are sending transactions, buying Bitcoin, sending it to their ledgers, sending it to their friends. Value of the network goes up, more people are using it, the price should soon follow. We looked at the confirmed transactions per day, confirmed payments, and unique active addresses, which are all metrics of the value of the network. So one thing that I would like to wrap up the video on, and it's a point that I made at the start of the video, but I really want to hammer it in. The price has absolutely nothing to do with the value of the network. I see a lot of people intertwine the words value and price. People say, you know, oh, this sucks. The value of Bitcoin has gone down today by 10, or, you know, today specifically, people are saying the value of Bitcoin has gone down 10%. You're not talking about the value, you're talking about the price. There's a difference between the price and the value. The value of the Bitcoin network comes from its decentralization and the amount of people using the network. The price of Bitcoin is simply the function of its supply and demand. That is basic economics lesson 101. Once again, I hope you enjoyed today's content. If you're an OG of the channel, welcome back. If you're new to the channel, as always, welcome. Hope to see you in the next update. And as always, most importantly, cowboy out. Peace.